Hello friends, this is Ankur Kulshrestha welcoming all viewers to the session on closing bell for equity investments which form 10% of your course at level 1. So I hope that you have been looking at this series called Closing Bell for all the modules, and just to reiterate, the idea to create these videos, very short videos, is not to comprehensively cover the course but to highlight some of the areas which we believe are super critical and very important from an exam success point of view. So let's say for equity we've had 10 questions. So for equity we have 5 questions. For COPFIN we had 10. For FRA we had 10. So it's going to be pretty variable in that sense. And the idea is, again, like I said, that a student should definitely cover at least these for the purpose of the preparation effectively for the exam. So the way we have been doing for other modules, exactly the same we will do here as well. So you got to pause the screen right now, take a shot at this question yourself, and then continue the video to look at whether your answers is equal to mine. Okay, so that ways people who have revised the course would assess themselves, and people who are at the fag end of their preparation in terms of before revision will be able to kindly assess whether they have been able to get the concepts right. So for both set of students, it's going to be preferable. So here I am starting with my first question, which says that an investor borrows the maximum allowed by the initial margin requirement of 40%. So this is like the key figure, to purchase 100 shares of a stock selling at 60 per share. Now here the total requirement, if I would have purchased it outrightly, is 6,000, but my equity participation is only 40%. That means I have put in only $2,400 and the balance 3,600 has been taken on interest. Okay, so that's the 40% margin that we are talking about here. If the investor sells the stock when its price increases to 70, her return will be close as 2. So that's my first part. So I'm not looking at the second part right now. So my return effectively is equal to the gain that I am making divided by the initial investments that I have to shell out. Okay, so here the initial investment that I have to shell out is 2,400, which is 40% of 6,000, and the gain that I have made is 70 minus 60, which is $10. Multiply that by 100 shares, so that comes out to be 1,000 upon 2,400, which is equal to 41.67%. Okay, so that's the part of 1 for me. Now let's enrich the first part and say that he has paid 5% as commission on purchase as well on sale. Now in the exam, pay attention, because it is not always true that the commission would be on both the aspects. It could be on either of the two. So be very careful and watchful about these small issues. So here in this question, he has paid 5% for both the transactions, the purchase as well as sale, and the call money rate is 4%. Now again, there's like an additional information. This role of this call money is the amount of debt that you've borrowed will now come at a cost, and that cost, which is 4%, needs to be deducted from the profit that you have been able to make, which is this numerator. So again, my formula basically is going to remain same, which is my net gain divided by my initial investment. The only thing is, now my initial investment will not only be equal to 2,400, but the commission that I have to pay on the entire trade. So the entire trade value was 6,000, on which I have paid 5% as commission, which gives me a number of $30. Okay, so that's my 2,430, beg your pardon, $300. So that gives me a figure of 2,700. so which is 2700 here, okay, as my initial investment. Now let us see how much is the gain that has been made. So the basic gain is 70 minus 60 into 100, which is equal to 1000, reduced by the commission on purchase that he has to pay minus the commission on sale that he has to pay. And on sale, the sale value is 7000. 5% of that will be 350. Okay, and on top of that there is an interest also that you have to pay. So 3600 into 4%, and now I have to look at as to what is the time on after which it has been sold, because now the periodic rate will have to be used. So if nothing is mentioned, I'm going to assume that maybe by the end of the year he has been able to sell. So 3600 multiply that by 0.04 is going to give me 144. So that's your interest on debt. So the total value that I have been able to get is 1000 less 300 less 350 less 144. It is equal to 206 divided by 2700 is equal to 7.63%. Okay, so that's my answer for part 2. Now in the same question, just to enrich it further, it could have also been given that during the year some dividend would have been received. Now in that case, dividend would have increased the gain and my numerator would have gone up, and therefore my return would have also gone up. Okay, so every particular fact will have a impact. So if the call money point wasn't given, then this 144 goes out of equation. If commission on purchase isn't given, then this 300 would get cancelled. If commission on sale is not given, then this 350 will get cancelled. So that ways you got to be very careful about as to what are the things and what are the role of each particular information. So with that, I am good to move to my second question, and this is again a very, very critical aspect from a numerical standpoint at level 1, and honestly not only at level 1, it is also at level 2. So it belongs to equity valuation, and this is like pretty straightforward a question, but I've just taken for the sake of covering it as a basic hygiene factor. It says the Apple Incorporation is expected to pay a dividend. Now this is expected to, that means it is D1. The analyst expects the dividend to grow at 8% on a continuous basis. So this directly becomes my growth, the constant growth, which is equal to the return on equity multiplied by retention rate. The required cost of equity is 14%. Now this 14% is your KE. The justified value of the stock is equal to, now you're aware of the fact that following the Gordon growth model, I can calculate the intrinsic value equal to the D1 upon K minus G. What a lot of people are thinking about, that it wasn't IV, it was intrinsic value, justified value means the same, but in the formula it says it is P0. I'm going to come to that P0 point, and that's where my part 2 will come into picture. But right now I'm calculating the justified value as a present value of the future cash flows that are expected to get. So if I have to plot those, the future values are the dividends that I'm going to get. The present value of perpetuity is equal to annuity at T1 divided by R minus G. So annuity at T1 is my D1, my R becomes KE, and G is here. So the formula that Gordon had used effectively is for a geometric progression where each subsequent term is getting multiplied by a constant ratio. So filling up the figures for this, I get the values to be equal to $12, which is already D1. So had it been D0, I would have to make it 1 plus G. But right now it is not required. Minus 8%. So it is coming out to be $200 a share. Okay. My part 2 says, if the actual price is 212, then obviously, let me do the part 3 first. Would you recommend a buy or a sell? So the justified value is 200. There's always a rule that the actual market price follows the justified value. The price is expected to go down. Therefore, I will sell this particular stock. Okay, but that's my part 3. Let's talk about part 2. Now it says, what will be the IRR? This is a very important concept that I wanted to highlight, and that is that your IRR is nothing but the rate that you are expected to earn in the market. It is not the required rate that you want to earn. It is what you are expected to earn. So the way to calculate IRR is exactly the way we used to do it in our capital budgeting, and that was that you plot the cash flows, and IRR is the R of the timeline at which PVCI will be equal to PVCO. So if the actual price is already 212, so I can purchase this stock at 212, and what I'm going to get is a constant series of dividend which is growing at 8%, so on and so forth. So let IRR be the R of the equation. So at R, PVCO equal to PVCI, my PVCO is equal to 212. My PVCI is the present value of this dividend series, which is again equal to the formula that this geometrical progression has. So I get a value of pretty much similar. I want you to pay attention to this part, that this formula is pretty similar to this formula that we have used here. The only difference is here I had calculated intrinsic value, and the rate that I was using is the required rate, whereas now I am not calculating the intrinsic value. I already have the actual market price, and the rate also that I am using is not the required rate, but it is the expected rate. So here I am making a very important point, that when an analyst or a valuator makes an assessment of the present value and the rate is the required rate and the present value is the justified value, and these are based upon the assumptions. But when the same thing is done by the market, then it is the actual market price that you take, and based upon that the rate you get is IRR. So this is like an important relationship that all the students have to kind of understand analytically, that from the point of view of the analyst, it is a rate that comes up first, and based on that is your the justified value. Okay, so in this question, if I were to fill in the figures, the required rate given is 14%, based on which I've been able to calculate the justified value of 212, and the actual market justified value of my apologies 200. The market rate is given to be 212, based on which I now have to calculate the IRR. Now my IRR is again the rate at which the PVCI is equal to PVCO, and this is the equation that I was at. So this R is also of the same timeline. So if I have to calculate that R, I'm going to get 12 upon 212 plus 8%, which is going to give me a number of 13.66. So if you follow the IRR rule of capital budgeting, when the IRR is less than your cost, you should not accept the project, and that's what we are doing here. Okay, so I hope that this part is clear. Okay, so this is like a very critical and important concept, so please don't make a goof up for that. So the IRR here is the expected return, and the 14% is the required, which is the risk basis return. So moving on to the next question here, which is pretty much on the similar lines. We also talks about the equity valuation, but in a little different context. It says Jubilant Foodworks just paid a dividend of 0.8. So that said, this becomes my D0. The analyst expects the dividend to grow at 25% in the next 2 years, 15% in year 3 and 4, and 8% for the year 5 and after. Now the reason why I have chosen this question is to get a good handle on something called as G, and to learn when can you apply D1 upon KE minus G. The market required return is 10%. Now this is not the return for equity, this is the market's required return. The treasury bills are yielding 4%, and the company that I'm talking about has a beta of 1.4. So the first and the foremost thing, the easiest thing that I can do is I can calculate my risk adjusted return, which is required, is using my CAPM equation, which is the risk less 4 plus 10 minus 4 multiplied by the beta here. So 6 into 1.4, 8.4 plus 12.4% gives me my required, the risk basis return. This is not the return that I'm going to get. That's my WACC. Okay, so that's the R of my borrowing timeline. It's not the R of my investment timeline. Let's talk about you have to calculate the justified value, and the justified value is nothing but PVCI, which is all the cash inflows, which in this case of equity are going to be the dividend divided by 1 plus 12.4 on a suitable platform. So here, what the error that shouldn't happen is that I should not do like this: 1 plus growth upon KE minus G. Well, this is wrong. The answer is, the solution for that is, and the reason for that is that the growth has become constant not from the first year. So you cannot use the dividend of the first year. So the D1 here cannot be used for the purpose of this formula. If I look at it closely, it's in my fifth year. Year 5 and after, it's only in my fifth year that the growth is constant, and therefore I will be able to use D5, and obviously D5 is going to give me a value at P4. So there is like a 1 year time difference between the two. So if I were to plot that, the future cash flows, my valuation the fundamental remains same, that I'm going to plot the future cash flows and I have to discount them at the appropriate cost of capital. So 4 and this becomes 5. So my D0 is 0.8. The growth rate that I am being given are 25%, 25%, 15, 15, and then 8%. So what I'm going to do is I will calculate D1, D2, D3, D4, and based upon D5 to infinity, I'm going to calculate P4. Sum total the two, and here I will have the 4 cash flows. Okay, being discounted at 12.5%. So just note the figures carefully. 0.8 plus 25, then plus 25, then plus 15, then plus 15, and then I have to calculate this P4 based upon D5 K minus G, and therefore I'll have to do a calculation of 42.25 discounted, 1.4375 discounted, 1.25 discounted, and 1 discounted, which gives me a value of $29.36 a share. Okay, so that's like my final answer. The question might ask you different aspects here. One, it might trick you on what is the required rate, it might trick you on what is the terminal value, it might trick you on what is the final value, but you have to be very, very careful about that. The value of 40.6 sometimes would also be seen as one of the options, and a lot of students sometimes commit a mistake by just calculating this final number, forgetting that it fits into the entire overall picture, and they have to finally bring it back to T0. Okay, so with that I am good to move to my next question, which is on the market efficiencies. It says, what are the different levels of efficiencies that a market can have, and what are the different information that can help on a higher risk adjusted return in each category. Now, more than the question, it is like a discussion about the concept, very, very critical, and sometimes, not to, so to speak, a little confusing concept. Now, what you have to understand is the way the curriculum is designed is they have created a hypothesis, and that hypothesis is that yes, markets are efficient. Now, efficiency means that no one will be able to benefit more than the other. So a situation like this is not possible, that someone is able to earn greater return compared to the others. So the efficiency has got different levels, which is weak form, strong form, and semi-strong form. And there are 3 types of information that you might have while going in the market. Now this table pretty much summarizes the entire picture, so I would request everyone to just pause the video here and just look at this particular table yourself and try and read it. So the way it says is the available information with the market participant if you know only the historical price volume data and do a technical analysis. So the point is, by this kind of an information, would you be able to make any kind of money? So if the markets are not efficient, then maybe yes. But if the markets are efficient of any category, then maybe no. That means that the value that you're trying to derive out of technical analysis is already reflected in the market price, and therefore there is no fun in buying the market price and try and make an arbitrage with the intrinsic value. This is absolutely the same that if you're trying to calculate it only using the technical analysis. The second tool and the second level is the fundamental analysis, and essentially this is what you and I have been doing for the previous question. So the way you calculate the value of the price is given upon KMI or any valuation model for that matter. This is like the company's fundamentals. Okay, now the value which is based on that is based upon the public announcements that the companies have done. Important point, obviously the analyst got to read the Economic Times, the newspapers, etc., to to know which way the company is going, so that they are able to project the cash flows, they are able to make an assessment of the cost and let's say the relative growth. The short point is that in all the fundamental analysis, you do not have any insider information, but you're still futuristic. You are not historical only, pretty much like the technical analysis. So fundamental is still futuristic. So the assessment is that if the markets are weak form efficient, then maybe anyone who is a good analyst will be able to make money. But if the markets are semi-strong or strong form, then even the intrinsic value would still be equal to the market price. The intrinsic value which is created out of this would be equal to market price, and therefore in these two markets, even if you have that fundamental analysis will not help you kind of make any money. So the value that you're trying to derive out of fundamental analysis will already be factored into price, and hence there is no point of doing this if I am falling into these two categories. But yeah, I mean, there is a third tool, the third information, the third very, very important aspect is about the information which is non-public but yet material. This is also part of my ethics, standard 2, part A, the market manipulation or material non-public and all that stuff. So A and B. So here you have the same information which is generally there with the insiders like CFO or CEO and people like those, so associated with important decisions. So if you have an information like that, then obviously you can make money when the markets are not efficient. I mean, in that case, so in any case you can make money. But with these two forms also, even if the market is semi-strong, you can still make money if you have insider information. That means to say that if I am an insider, my returns can be more than a person who is a non-insider. But in the strong form efficiency, even if I am an insider, the value that I am trying to derive out of this info is again factored into the market price. The market price has adjusted itself to the value that the information that an insider has, and therefore the true intrinsic value is equal to market price, and therefore in a strong form efficiency it is still not possible to have any kind of arbitrage, and hence there is no point of investing as such. Okay, so like a very, very summarized way of looking at the entire chapter. So moving on to my fifth, pretty much the last concept here, which is on the indices. Different types of indices. The key point from an exam standpoint is that every indice is divided on the basis of the weights. What are the different weights that are being used, and how have you created that indice? If the index has been based upon the price, then it becomes a price weighted index. It is based on market value, becomes respectively, and if it is not based on anything, then it becomes an unbiased or equal weighted, or should I say, unweighted index. So they're like the three broad categories. So here the question talks about of the market value weighted index. It says that the opening value of the index is 1280 unit. I need to find out the closing value. So the way to do that, the question like that is, I need to first calculate the market capitalization of the entire this thing at T0. Then I will calculate the market capitalization at T1. And the way I'm going to do it, that the value of index at T1 is equal to M cap at T1 divided by M cap at T0 multiplied by the opening value of the index. It's pretty much the unitary method, honestly, which means that I can also restate that as, if at 1280 you're getting a market cap like that, then what's going to be the value of index if you have a market cap like that? So let's just first calculate. These are the two variables that we got to calculate. So you multiply the two, you get 20,000 plus 105,000 plus 3 lakh. It is 4,25,000. Okay. Now the closing prices and the closing number of shares is 25, then 45 and 4 lakh. 4,70,000. So here I've got all the values that I wanted. So it is 470 divided by 425. Doing a quick maths here. 470 divided by 425. Multiply that by 1280. I'm going to get a value of 1416 units. Okay. Now the sub part here is that, would your answer change if company A has split their stock 3 for every 1? That means now the price that I'm looking at is going to go down by 1/3 and number of shares are going to be multiplied by 3. But the effective point is that you still, if you multiply the number of shares and the price, you're still going to get 25,000, which you have got earlier. So my answer to that is going to be no. This is like a famous question as to which of the indices would be biased if the price is split or consolidated. The answer to that is it's only the price weighted index which will have to be readjusted, or which will get disturbed because of that. Because in case of unweighted index, there are no weights as such. In case of market value index, the market value remains same. Either you make a stock split, or you make a stock consolidation, or you issue bonuses. So all the 3-4 activities are like reorganization of capital and doesn't really impact the market value, and hence answer to this question is going to be no. But read the question carefully. If this would have been a price weighted index, then the value would have been pretty much different. Okay, so let's just quickly do the same question if it was a price weighted index. Okay, now if it would have been a price weighted index, then I would have one share of the company as such for all the companies possible. So it is 20 plus 35 plus 60. So I'm getting a number of 115, and by the closing I'm getting a number of 25 plus 15 plus 80. So I'm getting a number of 120. So if my opening index is 1280, what would the closing value be? So I'm going to get this time a number of, like that. So again, the formula remains same. The way you index it, 120 divided by 115 into 1280. So had this question been of a price weighted index, my answer here would not have been 1416 but 1336. Okay, and if the company A would have split their stock, then obviously this value would have been changed. I mean, this would have gone down, and to adjust for that, then I would have to adjust the divisor accordingly. Okay, so those would have been different issues, and I don't want to get into that right now. It's like a separate topic altogether. So do these aspects very, very carefully as such. So with that, I'm pretty much at the end of this. We just wanted to highlight some of the very critical aspects, although I like theoretical aspects, so didn't want to cover them by way of numerical questions. The difference between expected and required rate is something that we have done. Your expected rate is your IRR that your market is going to tell you, and the required rate is your WACC, which an analyst is going to have on its own. Different aspects, again, like three types of preference shares. All three are very different and based upon different fundamentals. A convertible one versus a non-convertible means a convertible could be converted into equity. It has got nothing to do with whether it's cumulative or participating. A cumulative preference share, on the other hand, is one where if the dividend is not paid for a particular year, that dividend is not missed but is accumulated and paid later upon. A third category is participating versus non-participating, wherein the participating shares are those whenever the company scores a profit above a certain level, then these guys not only get their fixed coupon dividend, they also tend to participate in that extra surplus that the company has been able to make up for. So these are like three different aspects, very independent and of each other. Then there is concept of peer versus comparable. Now these have been the terms which have been used in the industry and company analysis. A peer is one which will have the business activity, economic driver and cost structure, BEC is I would call it, which is absolutely same as my subject matter company. So peer necessarily has to be of the same industry, of the same value chain, of the same size, etc. But a comparable sometimes may not be the one. Sometimes you tend to compare Apple with Google. Sometimes you tend to compare Google with Toyota. Sometimes you tend to compare, for example, Toyota with Sony. They both being the Japanese giant. Google and Toyota both being the market leaders. Apple and Google again being the two biggest companies in the Silicon Valley. So short point is that a comparable sometimes is a loser term. Is pretty much like a not a very tight and a strict term as such. But a peer has to be really the one which has similar B, E, and C, which is the business activity, economic drivers, and cost structure. There is something called as cluster groups, which is like the classification of the companies that you have done based on the percentage return that these companies have been able to make. So this is like the most dry, absolutely statistical, no logical relationship, the basis of classifying different companies. And again, I'm coming from an important standpoint that cluster as a word should be memorized and recalled in the exam very quickly. So if let's say I create some band, so whatever be the industry, whatever be the product, whatever be anything of that company, if any company has scored between 0 to 5, all that will be put in this particular cluster. Any company which has scored 5 to 10 will be put here, and 10 to 15 will be put here. So this way of categorizing different companies is called as the statistical basis or the cluster basis. Okay, and the last point here is my point 2, which is on the industry life cycle. Look at those things very carefully: the embryonic stage, the growth stage, the shakeout stage, the maturity stage, and finally the decline stage. Okay, obviously the names to be remembered is like, it's like a no-brainer, but you got to also be very careful about the characteristic of the competition in each of these stages. For example, in the embryonic stage, this is virtually no competition. In growth stage, the competition is increasing. In shakeout, it is at its peak, and there will be a pattern for profit, there will be a pattern for demand. So for all the 5 stages, these parameters have to be very carefully done as such. So with that, I am towards the end of my video on equity. So I hope that you enjoyed it and had benefited from it. So this has been an initiative from Finstudyclub, and the instructors. I hope that you have already looked at the videos on other modules. The idea really is to make sure that you are covered with at least the most important part. There is no percentage that we can really quote as such, but yeah, we are very sure that the topics that we have been covering in the closing bell series are the ones which have got the maximum chances of being tested, given the experience that me and Amit have. So wish you all the best, and I hope that you benefit from all these videos on different topics. So with these words, I say bye bye, and so wish you all the best and look forward to speak to you in my forthcoming sessions. Thank you.